Many investors eventually reach the same financial crossroads, deciding how to deploy $50,000 to maximize their wealth over the next 20 years. To see the math clearly, we have to look at two identical starting points. Two people, same age, living in the same city, both earning $55,000 a year. The only difference is where that 50 grand goes. Jake chooses real estate. He uses the $50,000 as a 20% down payment on a $250,000 rental property with a 30-year mortgage at 7%. Marcus chooses index funds. He drops the same $50,000 into a total market fund and sets up an automated contribution of $300 a month. In year one, Jake has a house, a tenant, and a story to tell at dinner parties. He can drive past the property and point to a physical asset he owns, while a rent check hits his account every month. Marcus has a brokerage account and a confirmation email. His coworkers nod politely when he mentions index funds, but he has no keys to show off and no tangible asset to point to. Jake has the keys and the story, but the math is indifferent to the physical reality of the house. Over 20 years, the wealth gap is determined by the net return on effort, not the feeling of ownership. By year 3, Jake has collected nearly $17,000 in gross rent. On a napkin, it looks like a winning strategy. That the actual cash flow is a different story. This chart shows how that $17,000 is eroded. First, taxes and insurance are sliced away. Then comes maintenance. Water heaters and roofs are guaranteed unpredictable costs. Finally, factoring in vacancy and listing costs, the actual net cash flow is between $2,000 and $4,000. To even keep that small profit, Jake has to manage the property himself. That means late-night phone calls and weekend repairs, effectively turning his investment into a part-time job. However, real estate has a specific advantage. This diagram shows how Jake uses $50,000 to lift a $250,000 asset, using the bank's money to control the growth. This 5-to-1 leverage means that even modest 3 or 4% annual appreciation creates equity gains that the cash flow alone couldn't touch. While the net cash flow covers the job of being a landlord, the leverage is what builds the actual net worth in the early years. By year 7, Marcus's portfolio has grown to roughly $140,000 through his automated contributions and market returns. He hasn't spent a single hour coordinating repairs or screening tenants. His growth required 0 manual labor. The trade-off for that freedom is the lack of a buffer against market price changes. In the stock market, your net worth is updated in real time, every single second of the trading day. This graph shows a 30% crash. If Marcus watches his $150,000 fall to $95,000 in weeks, he must have the discipline to do nothing. Most investors struggle here. They sell at the bottom, locking in a loss and missing the recovery that follows. 10 years in, both investors hold roughly $175,000 in equity. They reached the same financial milestone, but their paths to get there looked nothing alike. Jake spent hundreds of hours managing his asset and took on 6 figures of debt. Marcus contributed his cash and managed his own reactions to the market swings. At year 20, the two paths often converge at a net worth between $400,000 and $500,000. For Jake, the property is nearly paid off. He has decades of equity, but he has also lived through 2 decades of maintenance, tenant turnovers, and at least 1 major renovation. Both investments compound over time, but the stock portfolio eventually reaches a point where the growth outpaces the original contributions. This curve shows what happens if Marcus increases his monthly contribution by $200. Because it's automated, the adjustment is seamless. That small change pushes the 20-year portfolio towards $600,000 without requiring any additional time or management from Marcus. For Jake to see a similar jump in returns, he likely needs to buy a second property. That means taking on more debt, screening more tenants, and doubling his physical maintenance workload. Both paths grow, but scaling a stock portfolio is a matter of adjusting a contribution. Scaling a real estate portfolio requires the acquisition of new debt and new operational responsibilities. Deciding between these paths means choosing which currency you want to spend, your time or your tolerance for risk. Real estate is for the active business builder. It rewards those who use tax shelters, leverage, and strategies like house hacking to accelerate their equity. But property is a poor choice for anyone looking for a truly passive income. Without active management, the costs of maintenance and vacancy will erode the returns. Index funds are for the wealth builder who prioritizes time and geographic freedom. It is a path that requires zero operational work and offers instant liquidity. As the decision matrix shows, the cost of that freedom is the lack of leverage and the need for the discipline to ignore market volatility. The most significant mistake is making a 20-year decision based on a headline without looking at the specific costs of the path you're choosing. Before you follow an investment strategy, look at the math yourself and ask if the person pitching it included the cost of their own time and stress. The answer to that question is what determines your actual return.